Lecture 4, Market Entry Strategies, Global Market Entry Strategies, Part 2. The question is how we will enter our chosen market. 3 factors driving entry mode choice: high control, hierarchical mode, medium control, intermediate mode, and low control, export mode. High risk or hierarchical mode, medium risk, intermediate mode, and low risk, export mode. Low flexibility, hierarchical mode, medium flexibility, intermediate mode, and high flexibility, export mode. Risk and control in market entry. Making a decision on market entry poses questions. 1. What level of control over our international business activities do we require? 2. What level of risk are we willing to take? 3. How much cost can we afford to bear? And 4. How much control do we have over marketing activities? Mode choices for market entry. This diagram illustrates the risk on the horizontal axis and control on the vertical axis. Indirect exporting, piggybacking, trading companies, export management companies, and domestic purchasing represent low risk and low control. On the other hand, direct investment, owned subsidiary, acquisition, and assembly represents high risk and high control. The other levels and modes lay in the middle between the two extremes. Concept 2, Entry Mode Categorization. The diagram illustrates the export mode, intermediate mode, contractual split between another partner, and hierarchical, full investment and control from headquarters. Export mode, 100% externalizing, low control, low risk, high flexibility. Intermediate mode, contractual, shared control and risk, split ownership. Hierarchical mode, investment, 100% internalizing, high control, high risk, low flexibility. Market entry modes. This diagram flowchart illustrates the different market entry modes. Export mode on the left illustrates the company sets the price and the distributor/importer/dealer pays and then sells at a markup profit to the retail chain, who in turn marks up the price to sell to the end customer. The intermediate modes share the risk with another firm B, who set the price to be used by the joint venture, new firm C. They decide what price to sell to the retail chain. The retail chain marks up the price to sell to the end customer. The hierarchical mode determines a price with a foreign sales subsidiary, benefits from internal transfer of prices and repatriating profits, hence tax savings and benefits, controls the pricing that the retail chain sells to end customer. In most cases, the retail chains are company-owned and managed by the headquarters. In most cases, this also results in more efficiency of pricing for the end consumer, as there are now fewer or no intermediaries. Market entry modes. This diagram illustrates deciding between alternative market entry modes, including also using a distributor, licensing, and joint ventures in the foreign country as simultaneous or standalone alternative entry modes. Be curious about the marketing world. Brand Bank Task 1. Provide an example of a company that only exports in the weekly seminar forum. Which companies export? Pros and cons for their entry mode choice. Exporting examples: Parma, Italy, VCP Champagne, France. Examples of firms' products are manufactured in the domestic market or third country and then transferred to the host country as an export. Exporting. Advantages: limited investment, low risk, ability to realize location and experience curve economies. Disadvantages: higher unit costs to consumer, likely lower market share, limited learning on country market characteristics, in some cases trade barriers, transport costs. Exporting direct modes. Direct exporting occurs when a manufacturer or exporter sells directly to an importer or buyer located in a foreign market area. Direct export modes include export through foreign-based agents and distributors, Distributor, an independent company stocking manufacturer's product. Freedom to choose customers and pricing. Represents manufacturing and sales and servicing. An agent, independent company selling on to customers on behalf of exporter. Does not see or stock the product. Paid a commission by manufacturer. Be curious about the marketing world. Task 2. Provide examples of intermediate modes and post in the seminar forum. Identify examples of licensing, franchising, joint venture, strategic alliance. Intermediate modes. Reasons for setting up overseas manufacture and service operations. Product. Avoid problems, e.g. perishability. Services dependent on local knowledge and intellectual property. Transport and warehousing. Costs of transporting heavy, bulky goods is reduced. Tariff barriers. Barriers to trade are reduced. Intermediate modes continued. Government regulations. Entry to some markets enhanced by investment in local operations. Market. Local manufacture and service operations viewed more favorably by consumers. Government contacts. Contributing to local economy. International culture. Local presence ensures greater commitment by the firm to international markets. Delivery. Faster, just-in-time response. Licensing. A contractual agreement whereby one company, a licensor, makes an asset available to another company, the licensee, in exchange for royalties, license fees, or some other compensation. Patent covering a product or process. Manufacturing know-how, not subject to patent. Technical advice and help. Marketing advice and help. Use of trademark, trade name. Licensing continued. Advantages. Provides additional profitability with little initial investment. Provides method of circumventing tariffs, quotas, and other export barriers. Attractive return on investment. Low cost to implement. Disadvantages. Limited participation. Returns may be lost. Lack of control. Licensee may become competitor. Licensee may exploit company resources.